If you're a homeowner, you'll know what I'm talking about. And whether the exterior of your home is wood, brick, stucco, or paint, season after season, the home can develop cracks. And if you're not maintaining the home, that's when the big problems can occur. And it's like the stock market. Only a few people are paying attention, and the market's beginning to show cracks, and we're getting near a breaking point. Let's take a look. I'm going to begin here with the chart showing the velocity of money, and it shows the velocity since 1900 through 2017. And this is one of the most important charts that I'll probably ever show you, or at least that I've shown you so far. And you're going to need to remember this information for the future. So all of my subscribers, pay attention. This chart here is from Lacey Hunt, who's the chief economist at Hoisington Management. And he's an all-around monetary genius. And he's only one of the few that are watching the velocity of money. And the velocity has been falling for the last 20 years, as you can see. And if you want growth, particularly growth in GDP, you don't want to see this chart. What exactly is the velocity of money? In simple terms, it's the frequency with which the same dollar changes hands when the holder buys something. So it's in kind the churning of the money. And higher velocity means more economic activity, which usually means higher growth. It's somewhat disturbing to see the money velocity now at its lowest point since 1949, and we're at levels associated with the Great Depression. In the last decade saw an average of only 1.9% annual GDP growth. So I think we can attribute that slow growth to the ongoing fall in the velocity of money. And the velocity has been falling for quite a few years now. So the indicator by itself doesn't necessarily signal imminent doom. But the further below the average it drops, the more likely problems become. And looking at the chart there, you can see that the average is around 1.75. And we're currently at 1.43. So velocity is related to inflation, and this is really important here. Again, velocity is related to inflation. So when you hear about people talking about inflation coming, well, it's not likely coming. And you can see here in the chart. So if inflation does go up, money velocity also picks up. But as you can see, there's no sign of the money velocity increasing. And so you can expect that there isn't going to be any inflation risk here in the near future. Again, I cannot stress how important this is. Money velocity has been falling for at least 20 years, and there's a very good correlation with yield rates as well. Let's go to the next chart. And this is the GDP per dollar of business debt. And debt's another big issue for Lacey Hunt, again, the chief economist at Hoisington Management. And debt is like addictive drugs. And as with most drugs, the dose needed to achieve the desired effect tends to increase over time. The less effective that the drug is, the more the drug you need to provide. In this situation, the analogy is the less effective that every dollar is, the more dollars you have to throw at it. And so looking at the chart, you can see that the additional economic output, or GDP, generated by each additional dollar of business debt in the U.S. And you can see at the very beginning, way back in, say, 1952, we had a level of about $3.42 of GDP per dollar of business debt. Currently, we're somewhere around $1.39. And so as you can see that the U.S. debt has become less stimulative over the last several decades. Now focus specifically on the lower right area since about 2009. We saw the debt growth effect rise, but only for a couple of years as the economy came out of the recession. It began sliding again right about the time that Ben Bernanke said that the Fed would begin tapering its quantitative easing program. But now it's almost back down to where it was in the trough of the recession. That's not encouraging. And as a side note, it's somewhat interesting looking at information from China that Chinese debt is even less effective. It's less than 50 cents per dollar spent. And let me just provide you a side note here. I'm showing these charts to you, specifically the money velocity chart, because I'm beginning to build the foundation for my thesis or argument. And that is what I'm going to call now the next bull market. I'll come out with a video here in the next few weeks or so, which I believe will be the next bull market. Not the bull market in the stock market, but an investment that will be the next bull market. I'm trying to find a way out, a way to avoid the turbulence and the destruction of a bear market that I believe is coming. And I think I now have an answer. But there are some things that we need to talk about and some concepts that we need to better understand. So please take note. Okay, let's go to the next chart. And this chart here from Louis Gave of Gave Cal Founders. And this is the chart of the 30-year Treasury yield since about 2010. And it is true that this chart of the 30-year Treasury yield is a little bit different than charts of, say, the 10-year yield or the 2 or 3-year yield. But let's just go with it. And two things to note on this chart here are, one, the relatively consistent downward trend line from the very upward left to the lower right. And the other thing to note is the recent breakout, say in 2018, the recent breakout above that trend line. And it was no great surprise that long-term bond yields fell steadily as the Federal Reserve was buying these long-term bonds. With the recent economic pickup, it shouldn't be a surprise either that yields continue to rise even if the Fed has not continued its quantitative easing program. But other things are happening too. And if a U.S. economy that is growing slowly at best, along with continued stimulus from Europe, China, and Japan, isn't enough to keep U.S. bond yields from rising, well, what will? The answer is a recession. And if yields rise much more, recession odds will also increase. And by definition, recessions are deflationary. And we'll see interest rates decline in the developed world when a recession comes along. And that prospect is very real given how low rates already are. Let's go to the next chart. And this chart here from Gave Cal Founders shows the USA budget deficit or surplus as a percentage of GDP. And as you can see by the chart, over the last half century or so, higher deficits typically have been associated with recessions. And as a recession ends, the deficit shrinks. Occasionally, we get a surplus, not very often. And that's not happening this time. The deficits are now growing again, even without a recession. On the positive side, today's annual deficits aren't anywhere near the 2009-2012 levels. That's encouraging. But in the next recession, tax revenues will likely fall and spending will likely have to increase. And that's going to grow the annual deficit and add more than about $2 trillion to the national debt each year. So we're using up our breathing room, and that's going to be a problem sooner or later. I think it's going to be sooner. And this last chart here shows the U.S. monetary policy from 1979 through 2017. And if you can't quite make it out, I'm going to read it here for you so that you understand. And basically what's happened here is each of the Fed chairs during their tenure, their average Fed rate was calculated. With Volcker from 1979 through 1987, the average Fed funds rate was 10.55%. With Greenspan from 1987 till 2006, his average rate was 4.8%. Ben Bernanke from 2006 to 2014, his average rate was 1.5%, and with Janet Yellen from 2014 to 2018, her average rate was 0.5%. So it remains to be seen what Powell is going to have during his tenure, but my bet, we might be in negative territory. We'll have to wait and see. So for today, that's ChewDog Charts. Thank you.